Staring at a red screen creates a specific kind of pressure. It feels like the market is signaling a fundamental break in the economy. But the data tells a different story. The current sell-off isn't being driven by internal corporate failures or weak earnings reports from India's top firms. This diagram maps the actual external stressors: rising crude oil prices and a weakening rupee. These global factors make imports expensive and squeeze margins. We're also seeing foreign institutional investors pulling capital out of emerging markets to seek safety elsewhere. These external pressures create a mathematical gap between share prices and actual business value, a systemic discount for investors with a 3-year horizon. When the index drops, capital behavior splits. Most investors react to the price movement, while strategic capital focuses on the underlying assets. Common mistakes include panic selling industry leaders at the bottom or moving capital into low-quality penny stocks because the low share price feels like a bargain. For those with cash available, the challenge isn't finding a discount. It's the paralysis of choosing where that capital will be most effective over the next 24 months. Instead of trying to time the absolute bottom of this dip, we are going to evaluate 5 specific sectors to see how they map to your actual financial goals. Success in a volatile market requires a strict alignment between the volatility you can endure and the time you can afford to wait. To decide, we test sectors against a clear framework. We start with defensive foundations, banking and power, including HDFC, ICICI, and NTPC. This capital is backed by consistent loan growth and massive infrastructure requirements. Their balance sheets resist global shocks far better than emerging industries. However, prioritizing this level of safety has a cost. You are choosing capital preservation over the explosive triple-digit growth found in higher risk segments. Banking and power serve as the bedrock of a conservative portfolio, designed to survive volatility rather than profit from it. If your timeline is longer, you can move towards sectors driven by national industrial trends rather than immediate stability. Next are the structural growth engines, the auto and defense sectors, featuring Tata Motors and Bharat Electronics. The thesis relies on a multi-year manufacturing boom and the transition to electric vehicles. This provides exposure to long-term industrial growth, but with significantly higher volatility. Because these sectors are high momentum, they can experience much sharper corrections if government spending cycles shift or consumer demand fluctuates. These growth engines require an investor who can tolerate significant short-term price swings in pursuit of a 2026 or 2027 payoff. Our final category is the contrarian value play, centered on the deeply corrected IT sector, specifically Infosys and TCS. Buying here allows you to acquire world-class businesses at a rare discount, provided you are committed to a strict 3-year holding period. The risk is time. Your capital may remain unproductive for months as you wait for global technology spending to rebound. Effectively managing this risk requires a specific execution strategy for your entry points. By using a systematic approach, buying in parts on red days, you mathematically lower your average price. This protects you if the market continues to slide after your first buy. This staggered entry means you will likely miss the absolute lowest price point of the year. Giving up the chance at perfect timing is the price you pay for emotional stability and significant risk reduction during a dip. A market correction moves capital into the hands of investors who have mapped their entry points in advance. To determine your next move, look at this decision flow and identify your primary goal for the next 2 years. If your priority is capital safety and being able to ignore daily market headlines, focus your foundation on the banking and power sectors. If you are looking to build a portfolio for 2026, blend the manufacturing momentum of Tata Motors with the deep value of the IT sector. Avoid the quick rebound trap. Do not be tempted by low-quality penny stocks that look cheap on a screen. When sentiment shifts, high-quality leaders with real earnings recover first. Low-quality companies often stay at the bottom long after the market has moved on. Pick your path and commit to your timeline. Comment below with your portfolio target for April 2026, and let's see which strategy you're following.